Dear honorable students, now we just concluded our activities on duration. Let's now look at convexity. Remember, at the end of duration, I made mention of convexity, that this is a concept that demonstrates how duration of a bond changes as the interest rate changes. Now, when we are talking of duration, if I can just do a little recap, we said duration is the concept that describes or demonstrates how bond price changes as interest rate changes, or the changes in bond price to the changes in interest rate. That is what duration says. But convexity on its own is all about what? Is about changes in interest rate to the changes in duration of the bond. So convexity is a measure of curvature or degree of curve in the relationship between the bond price and the bond yield. So convexity demonstrates how duration of the bond changes as the interest rate changes. That is why it is necessary for our portfolio managers to make sure they use convexity as a tool in the risk management in order to measure and manage the portfolio exposure to the interest rate risk. Now, when we are talking of curvature, which really mean what duration explain, what convexity explain, is about trying to know the degree of curvature or degree of sensitivity of the bond price to the interest rate, degree of convexity, degree of sensitivity of the duration of a bond to the changes in the interest rate. That is what curvature does. Let me use diagram to explain this. Now we have something like this. This is our duration line. So from this line, we now have two bonds. This is duration. We have two bonds that tangent with duration like this. We call this one bond B. Another bond also tangent to the duration. We call it bond A. Now, this is the yield curve, and this is the bond price. Understand? We have the bond price, and look at this. This is where both bond intersect. Let me try to make this a bit explanatory. I will try my best to make it explanatory so you can get it once and for all. Now, this is where all these bonds intersect. Now, this is yield at this, and this is the bond price. Understand? Now, if that is the case, you see there's another price here. This is another bond price. This is another yield. And not only that, we have another price at this place, as well as yield. This is another bond price. What we are trying to drive at here is that you see that bond A is more curved than bond B. Understand? Bond A is what? Is more curved than bond B. What this simply means that bond A has a higher convexity than bond B. See bond A, it has a higher convexity than bond B, because we said convexity is the measure of a curvature, and bond A is more curved than bond B. So definitely bond A has a higher convexity than bond B, which indicates that all else being equal, bond A will always have a higher price than bond B as interest rates rises or fall. Understand? Bond A will always have higher prices than bond B as interest rate or falls. That's what the convention tried to explain in brief. But we need to go further. Let's try to explain this concept a bit further so we can get the proper perspective of it. Now, before we try to explain that, it is important to know bond prices and market rates relate to one another. How do they relate to one another? They relate to one another in an inverse relationship. We have inverse relationship, because as interest rate falls, the bond price will rise, and conversely, rising market interest rate lead to falling bond price. So this opposite reaction is because of as rate rises, the bond will fall behind the earning they may offer a potential investor in comparison to other security. And like I said earlier, understand, the diagram I made for you shows that bond A has a higher convexity than bond B, which indicates that all else being equal, that is all things being equal, bond A will always have a higher price than bond B as interest rate changes, either rise or fall. So the bond yield, understand, the bond yield is the earning or return an investor can expect. The bond yield is what an investor can do what can expect. Look at it here. This is the yield. This is the bond yield here. So it is yield that investor is expecting. This is yield 1, yield 2, yield 3. So we all discover that let's make this up. Let's make it up. There's a concept behind this that we do the explanation. Don't bother yourself. What we are trying to do here is that you can see this this yield for bond B, the price difference to bond A. Bond A always have a higher price than bond B at the same yield. Understand? Now, as I was saying, I said the bond yield is the earning or return an investor can expect to make by buying and holding that particular security. The price of bond depends on several characteristics, which include the market interest rate. Understand? So if the market interest is high, the bond price will low. If the bond price market rate is low, the bond price will high. That is a relationship between them. And let's now look at how market interest rate and bond yield relate. How market interest rate and bond yield relate. Now, as the market rate rises, we are trying to explain the relationship now. As the market rate rises, new bonds coming on the market also have rising yield as they are issued at the new higher rate. I don't think you understand what I'm trying to say. See, the concept behind it is that when the rate is high, understand, the yield from the bond, don't forget the rate is like the market rate, this like the coupon, and as the coupon increases, understand, those that are coming into the market, the new bond will come with higher yield as well. So the rate is like a yield we are talking about here. Understand? So once the rate increases, the investor will also demand a higher yield from the bond they buy. An investor don't want a fixed rate bond at current yield if they expect interest rate to rise in the future. As a result of this, when the interest rate increases, the issuer of this debt vehicle must also raise their yield to remain competitive. However, as the interest rate climbs, the bond price returning less than the interest rate will fall. That's the ownership. And aside this, let's also discuss how interest rate and bond price also relate. If an investor owns a fixed rate bond that pays 2% and interest rate begin to rise above 2%, they may want to sell this lower paying security, understand, for them to be able to get the higher rate in the market. The reason for the sell-off is that their existing rate is less attractive than the current market. So investors don't want to hold a bond that pays 2% if they can invest the same principal into one that pay higher rate in the future. So in a rising rate market, bondholder look to sell their existing bond and opt for newly issued bond paying higher yield. That is the relationship between the interest rate and price bond price rate. Because there's a glut of bond, what we are saying is that once all these bondholders want to sell their bond in order to get higher rate, understand, there will be a glut. I think you understand what a glut means. A glut is when many things are in the market at the same time, when supply is higher than the demand. So when the glut of bond increases as the lower rate at the lower rate on the market, the price of this bond will drop, and also as bond sets off, the price falls. The investor may wait for rates to stop rising before getting back in the bond market by buying the higher yield security. As a result, the bond prices and yield move in the opposite or inverse direction. We are trying to give you some of the reason behind the rules we just utter as a word of mind, that the increase in the interest rate lead to the fall in the bond price. You could see the reason behind it now. The reason is that when the rate increases, bondholder will want to sell off their bond in order to enjoy the increased rate. So if that happens, many bondholders will flood the market and there will be glut. Glut is when the supply is higher than the demand. So the supply of the bond will make the price of the bond to collapse and the bond will come down. And that is where the lot comes out.